Okay, let's start this. Let's give this a go. Welcome everyone to the Crypto Derivatives session, which we have the pleasure to co-organize with CME Group. Thank you so much, Payal, and the team at CME for being a partner in organizing this event for the second time. So much has changed since we organized the last one a bit over 1.5 years ago. We will unpack that and we will dive into it. We also have the pleasure of having Jean-Marie from CoinShares with us, who also was present in the last discussion, the last session, as well as we have Nicola straight from New York, from B2C2, and we have Dominic straight from Zurich, from Signum. I haven't introduced myself. My name is Emi Lorincz, and I have the pleasure to be the president of the Crypto Valley Association. And in my full-time role, I work for Talos, the premier trading infrastructure provider. And Payal, why don't you introduce yourself? I would love if all of you introduce yourself and just share a bit how your company is involved with crypto derivatives.
Oh, wonderful. Thank you so much, Emi. Thank you for having me, and so excited to be part of this really interesting discussion. So yeah, my name is Payal. My role is Director of Equity Index and Cryptocurrency Products here at CME Group. And what that really entails is creating new and innovative products around key equity indices. So things like the S&P 500, the NASDAQ, the Russell, Dow, and as well as in current cryptocurrencies like Bitcoin and Ether. So CME is the world's largest and most diverse derivatives exchange. We go back about 180 years, but our involvement in the crypto space actually began back in 2016 when our clients were asking about crypto, and they had an increasing need for risk management, for efficient markets and price discovery. And so really since 2016, we've been very involved in the space, bringing both reference rates for Bitcoin, Ether, and other cryptocurrencies to market, as well as Bitcoin and Ether futures and options as well.
Emi, I think you're on mute.
Thank you. I added to Payal's point that I haven't realized it has been over 180 years that CME Group has been around, quite remarkable. And Nicola, would you like to go next?
Sure, thanks. So Nicola White, I'm the CEO of B2C2, really excited to be here today. It's a topic I think comes up more and more. Which is exciting for me because I think it means that the industry is really progressing in the types of products that are available and clients can get access to. So B2C2 is a true principal liquidity provider. That means that when you trade with us, you're putting we're putting our capital to work, and we're really creating liquidity. We trade everything from spot crypto to options to lending products to CFDs and NDFs. And our client base is institutional, so we don't face retail directly. With creating liquidity and using our capital to create liquidity, we put a robust risk management framework around that. I think it's pretty topical in light of some of the events that have happened recently. So maybe we'll go into a little bit of that throughout the panel as well.
Thanks so much. And Nicola, since when are you guys around?
We've been around since 2015. So, I would say on the earlier side of companies in the crypto space.
Super, 8 years and going strong. Thank you. Jean-Marie?
I'm Jean-Marie Mognetti. I'm the CEO and co-founder of CoinShares. Since we're talking date of birth, CoinShares has been around since 2013 in crypto. So I was working with Sandra, who was on the steering committee for the CME to creating this product. I was working with Max, which was the founder of B2C2 as well. So we kind of seen a lot of things in crypto over the years. CoinShares is Europe's largest digital asset investment firm. We have really two businesses right now, which is our asset management business and our capital market business. asset management business managed around $7 billion at the peak of the last market, more around 3.5 right now. And our capital market is, also like B2C2, a principal capital market business. We don't have clients, we just trade for our own money and for our own purposes. And obviously we're using CME product, obviously we're using B2C2 as a liquidity provider as well. And we are, keep trading and keep building our businesses in this lovely environment we are in.
Thank you so much. Dominic?
Yes, thanks, Emi, for having me on as well. I'm Dominic, I'm the head of trading at Sygnum. We can claim 180 years. We've been around since 2018, got the banking license in 2019 as the world's first regulated bank offering really digital asset oriented offering. And yeah, now at the moment we're active in services around custody, trading, obviously both spot and derivatives, but we're also offering a lending business, a lending offering, and various other services such as tokenization and so on. And yeah, Swiss based here out of Zurich, and we have a Singapore presence and presence in a couple of other locations as well that we will maybe also talk about later a bit more.
Thank you very much. Then let's dive in. Thank you for the intros one more time. So I alluded to this, Payal and Jean-Marie, that since we had our last webinar on crypto derivatives back in 2021, a lot has changed. There are some pretty obvious changes, but there are also some not so obvious changes for the people listening in here. Would you like to allude to some of the changes? Which are these, Payal?
Yeah, I mean, a lot has changed in the last month or the last quarter, let alone since our last webinar together. And I actually, when I think about it, and I think about the last year, I think that last year has really highlighted some real structural flaws in the crypto market. We saw the collapse of Terra Luna and its stablecoin UST. We saw the bankruptcy of Three Arrows Capital, Voyager, Celsius, BlockFi, FTX. And so the market has come a long way since that. And despite the crises of confidence in the US that we're seeing now, and actually globally, Bitcoin now has gone back up to 30,000, the highest level since June 22. And we're starting to see that sentiment of the central bank slowing their pace of interest rate hikes coming through, and meaning that risk on appetite is back. And so over the course of that last year, the last quarter, even though there's been turbulence in the broader crypto market, I think one of the things that has increased is the understanding and the appreciation of crypto derivatives, and in particular, our CME crypto futures and options. And I think there's probably a couple of reasons for that. And so, I think the first thing is that flight to quality. So clients definitely want to be involved in this space, but they want to be involved in a way that offers them regulation, that they have guardrails, and they have proven products. And we're really seeing that a lot of those investment decisions are centering around risk management. So where participants are maybe hesitant to trade on some of the unregulated platforms, we're sometimes benefiting from that flow. And from that, we're seeing more liquidity, we're seeing more market makers in our markets, and we're seeing very tight markets. So in fact, growth and in volume and open interest across our entire crypto suite over Q1 of this year has exceeded more than $3 billion traded in daily volume. So that's huge. We're seeing a lot of volume. And I think the other thing is that investment managers, asset managers, they're all now getting more comfortable with the volatility of crypto and the returns that it generates. And so that conversation, since we last had the webinar, that conversation with clients has changed from like, what where clients were initially asking, what is Bitcoin, what is crypto? That conversation is now, okay, we need to get into crypto. How much should I allocate? And when it comes to allocation, their sticking point was sometimes that they weren't able to access the spot markets or the unregulated platforms. And so between CME offering, our cash settled futures and the likes of, the B2C2 and CoinShares that offer the different components in the market, that ability to access, I think, has improved greatly. And so, with our contract, it's US dollar settled contract on an index on a regulated platform. So if we just unpack that very quickly, by a US dollar settled contract, that means that clients don't have exposure to the underlying asset. They have price exposure, but they don't necessarily need to handle things like the wallet. They don't have to deal with custodians or deal with security concerns like insurance. And so it makes access easy and does away with some of those barriers to entry. I talked very briefly about having those guardrails, and by that I mean from that 180-year experience that we have with all different asset classes, whether it's the volatility in oil or wheat, that we're able to test some of these mechanisms across different asset classes. So we have things like dynamic circuit breakers in place that prevent the market moving too fast or too quickly. We have position limits that protect customers against concentration issues and prevent some of those snowballing issues that we might have seen in other markets. And we settle our futures contract to an index. So there isn't any vulnerability on a price or any over-reliance on one spot exchange. And so, when we put all of these things together, and I think as we move forward, the idea of the segregated funds will really be appreciated by investors. And from our perspective and our platform, because we're CFTC regulated trading venue, and our clearinghouse becomes the buyer to every seller, there are no clawbacks, there's no auto liquidations. And so we feel that customers and clients are more willing to trade in the overall crypto ecosystem. And actually, as we see liquidations happening on those unregulated platforms, we see spikes in our volumes that correspond to that. So when we started Bitcoin futures back in 2017, we were doing 1,000 contracts a day. We're now doing over 10,000 contracts easily. And on some days, we're doing volumes of about 40 million. So it's all of those things that are coming together, I feel, that is really advancing the crypto ecosystem. And that's so exciting to see.
Brilliant. Thanks so much for unpacking this. Do you have anything to add, Jean-Marie?
Well, it was a very comprehensive resume of the situation, so I'm going to try to keep it very short. FTX, to start with that, kind of was a key reshuffler in the deck. A massive change of dynamic and concentration between different marketplace. What we saw as well is like a different type of client profile. Is that becoming a norm? Account control agreement becoming a norm. So professionalism in the standard of frameworks which are put in place are coming together and changing that. Just to come back on CME, volume are exploding. As we saw with FTX, volume means nothing. We can have a lot of volume with very few market participants. What is much more interesting is the number of large participants on CME, which is at the end of Q4 or Q1 around 400 market participants or large market participants, which is like more than 40 contracts, I think, in their account. So that's kind of a very interesting metric, which is changing the profile of the amount of participants in this market and showing that the market is maturing. we're still lacking a number of good FCM or quality FCM to manage a margin properly and pass some margin which are at the right level, and the margin are still very high, which are still taking people away, but that's improving. So hopefully everything is going in the direction of more transparency, more liquidity, and better product. And I'll stop there.
Super, thank you very much. We got a really comprehensive answer here, and also Jean-Marie, you highlighted on a few points which you think that are the most relevant when it comes to change. And because in the audience I realize not everyone lives and breathes crypto derivatives like the four of you, maybe let's take a step back a bit, and Nicola, I think you can answer this really well, and Dom, if you want to take this as well, that what are the various reasons why people use crypto derivatives?
Yeah, sure. So I'll start out with maybe a way in which I wish people use derivatives more, or we're starting to see people use derivatives more, which is hedging, right? When all of the events over the last year were going on, I can't tell you how many people came up and was like, my portfolio is down 30%. What should I do? Well, when your portfolio is down 30%, there's not a lot you can do because you're already down 30%. But I would employ people that are sitting on large treasury balances, or have just an outright net long in crypto, to think about trading options and buying downside protection. It's just good risk management, and I think it's something that there hasn't been that like broad availability of options until I would say over the last couple of years. And so excited to see that start to come out more. We're seeing a lot of our clients trade it more. The other reason I would say that we're seeing people trade a lot of crypto derivatives over the last year, which Payal touched on briefly, is just the fact that they don't have to deal with the complexities of the blockchain, right? If you look at traditional finance clients, especially some of the largest ones, they have legacy technology. They don't know how to handle, like even think about settling on the blockchain, wallet infrastructure, custodians. And so cash settled derivatives really can give them access to the space. It allows them to dip their toe in. And also it's something that their risk management teams are really familiar with, right? So the concept of an NDF or a CFD is not new to the traditional finance space, right? So if you go to your risk manager and you say, I want to trade crypto CFDs, well, they know how to model that. They know how to think about the risk on that. And so I would say those are kind of two of the biggest growth areas we've seen over the last year or so.
Thanks so much. Dom, do you have anything to add?
Yeah, I mean, I guess you could probably split the market in a number of different dimensions, right? You could look at institutional versus retail. You could look at who's trading options versus perps, etc. But I guess at Signum, if we zoom in a bit on our client base and we look at what we primarily see, I'd say it's probably two different kinds of clients that we're serving most. And I think the first one is what Nicola just touched upon. It's kind of the hedgers, right? So crypto natives, project foundations, founders, investment funds that have kind of quite a significant exposure either in their native token or in the majors as a result of maybe an ICO or any kind of activity that led to BTC or ETH exposure. And there we're seeing a lot of this kind of covered call oriented flow that a lot of them are just trying to hedge their exposure and lock in some yield on that, right? And I think there, and I can really echo what both Nicola and Payal said before. I think we look at this very much also as a kind of a synthetic token, if you will, the derivative, right? Because it also allows us, and in many ways you have with these special projects, you have maybe a token that is not liquid enough to have an absolutely kind of super liquid market that allows you to hedge that exposure very efficiently. So that when the spot market is not there, I think derivative and especially also for us going via a vast array of kind of market makers allows us to really hedge that exposure for the clients in a way that the blockchain never has to be touched, in a way that you can get around some of the AML topics, some of the risk topics, some of the custody support topics that you would have to kind of tackle when you talk about touching the token itself, right? So for us, it's really a synthetic token exposure. And I think that's the sort of the first client group that we're seeing these hedgers. And then the second one are more the speculators, so mostly individuals, which probably, to be honest, a lot of them could replicate their strategy on an exchange. But the reason they come to us is more to diversify counterparty risk. One of the benefits of Swiss banking law is that we can hold all our clients' crypto assets off balance sheet. So any collateral that you deposit with us for the purpose of a derivatives contract is completely off our balance sheet and hence not exposed to our risk, to our default risk. And I think that's something that especially the more sophisticated individual investors are starting to look for, obviously also in the aftermath of what we've seen in the last couple of months in the market.
Thank you very much. I feel like it's a good opportunity now to zoom a bit out and give the listeners a better understanding of these 4 relevant companies, relevant when it comes to advancing the evolution of digital assets. So it would be interesting maybe for some people to understand who trade your markets, who are typically your clients. And I would also like to encourage the audience to feel free to drop questions in the chat. We will take a few after 2 more questions. So Payal, you want to go first?
Oh yeah, fantastic. Yeah, thank you. So yeah, over the past 4 or 5 years, we've continued to expand our product suite to help institutions and sophisticated crypto traders manage their risk by trying to give them more choice, more precision, more accuracy. And actually, we've tried to bring over the course of 2022, 1 new product to market every month. So yeah, just a flavor of some of the things that we have. We have our standard institutional size contract for Bitcoin, which has a 5 contract multiplier, and for Ether, a 50 multiplier. And so those contracts really have a notional value of around 100 to 150,000, and very suitable for institutionals who are in this space. And then, we have also our micro offering, and really that was to help fine tune those institutional holdings or for the active retail participation. So, after COVID, and we saw a real uptake in retail interest, just as people were at home or they had more time or funds to get involved in the space. So those micro contracts have a 0.1 multiplier, so 1/10 of a Bitcoin or Ether. And so for Ether, you're talking about a $200 contract. So, really nice and small. And as Nicola alluded to, it's nice to have these contracts in market that help people to just dip their toes in, or for maybe a hedge fund to test some strategies out using those small contracts. And then we've really been tinkering with our options contracts as well to provide that downside protection that has been so useful over the past year or so. And so we've brought to market both monthly contracts and weekly option contracts as well. So people can really use those to manage that risk. And in terms of who's trading, right, it's all different personas coming together and different reasons why people are trading. So we have banks, we have prop desks, we have hedgers coming in. We've got firms that maybe have accumulated long positions in the spot markets, as Nicola alluded to try and manage that risk or hedge that downside. What a really interesting use case is actually miners or companies that accept Bitcoin for payment, for example, who would be long crypto. They could use maybe a 2-year term structure in Bitcoin futures to figure out how much they should be investing in capital expenditure or new servers, and how much to hedge against price movement. So the miner could very easily calculate how much return he's generating from mining, and how much, the price volatility, and how much he can reserve for capital expenditure. So it's becoming this really nice melting pot of all of these different personas and clients and use cases. And I think it's exactly that makes the market more efficient. And as we kind of step forward, we've seen the interrelatedness of both the spot and the futures market. And that's by the ETNs and ETFs that have come to market, the various funds, CFDs, the perpetuals. So you have, again, all of these different access points, and I think it's that brings tighter markets, and it's really a growth on growth story. And so I'm really excited about how the market continues to evolve, and actually how we continue to evolve and bring new products to market to help these clients.
Thanks so much, Payal. Nicola, would you like to go next? Who are typically your clients?
I mean, they kind of span, the gamut from, I always think about who gets in first, right? So professional trading firms, hedge funds kind of get into a space first. And then you'll have, treasurers and asset managers that'll follow next. And then finally, you'll have banks. And I think, the one thing outside of what I will say, maybe the CME, banks have been really reluctant to get into the space. I mean, the CME has the benefit of, having a 180-year history, and banks are very familiar with, the risk profile. But look, the sentiment is tough for banks right now. I think for them to get involved in any kind of meaningful way. So I'd say they're really the holdout in terms of the last remaining kind of class of clients that we're waiting to see get into the space.
Thanks so much. Jean-Marie, Dominic, who wants to go next?
So on the asset management side, I think, what is particularly interesting is the crypto market is kind of built upside down. Traditionally, you see a top-down approach where institutions allocate first, and eventually it permeates to retail. In the crypto market, it started all the way around. It started with retail or with consumer, and eventually find its way up to the institutional market. And so CoinShares traditional client base in Europe was based, I would say, between Stockholm and Milan, and they were mainly retail. And over the years, we have seen this kind of sophistication increase in the profile of our clientele to become today small and medium asset management company, family office, and to some degree even large family office and large asset management company. So that's quite different than what you would expect to see in all the market, and that was a typical specificity of the cryptocurrency market. For our capital market business, we don't really have clients, we have counterparties. These counterparties are scattered around the world, but we have pretty much every single Chicago firm as a counterparty, which show kind of the journey which has been achieved over the years, and how we went from a very niche market where back in 2013 our counterpart on the future side was a company called 796 in Shanghai, and today we have like every single market maker in the world which is offering market and kind of two-way market on this stuff. So it's a very, very diversified market today, and very interesting to look at.
Is that company still around, 739 Shanghai?
They went out of business long time ago. I think they disappeared in 2014 when Star from OKX started OKX. So it's kind of like, it's like a long time gone.
I see. Thank you very much.
You can also do betting on football game as well. So it was kind of a multi-type of business. They were like...
Let's not bring football into this conversation. Not yet. Dominic?
Yeah, I mean, not all that much to add. We have a similar profile here. I think there's the clients that we do have, the clients that I would like to see more, and the clients that we would leave to others. And if we look at the ones that we do have, it's what I mentioned before, right? The hedgers, the speculators. We focus on an institutional client base. So the ones that we would leave to others are clearly the retail space. That's not our primary focus and at Signum. And then there's the clients that I wish to see more, and I think there I can really second what has been said as well. I mean, the banks, and I would, obviously we're also a bank, but I would still consider us in a slightly different bucket than some of the banks that are really just touching crypto right now. And I would love to see them obviously getting more involved. I think there are a lot of opportunities, for example, in the structured product space, where a lot of them are already active today. And I mean, at the end of the day, a derivative on crypto is not all that much different from a derivative on FX. So there are definitely synergies that can be leveraged there. Love to see them more, but I think we have to be realistic. It's going to take a bit more time there as well.
Yeah, we can't really complain much in Switzerland when it comes to
fair enough, yes.
Adoption of banks, which is nice.
You guys might be the standout globally.
Yeah, I think by now there's not that many banks left that are crypto friendly outside of the US. Yes, indeed, yes.
Okay, we have to really good or nice, interesting questions in the chat, and we can take live. Aine Marie's question. Basically, she's asking CME and others, do you see or provide collars or straddles on crypto assets at the moment?
Yeah, so we, from the various option strategies that we have, it's completely down to the individual to put those strategies together. We see a whole gamut of different strategies come to market. So everything, as you mentioned, from collars to straddles to butterflies. So yeah, it's kind of that building block approach. We have the weeklies, the monthlies. With futures, we list futures all the way out. So monthly futures, quarterly, all the way out to December 2025 right now. So 2 full years out. So using that approach of those different pieces, it's really as far as the imagination can go, or what the best allocation of risk is to those strategies. So completely.
Thank you so much, Payal. Then I wrote to JJ Jones that we will take his question live, and that's the following. The unregulated exchanges Binance and Bybit have around 40 billion and 11 billion in perpetual futures daily volume, respectively. How are the regulated providers going to capture that market share in a cost-effective way? Are perpetual futures for CFDs going to play a part in this?
Yeah, I mean, I can take the first part of that. So, on a daily basis, our Bitcoin and Ether contract, we're trading, as I mentioned, about 10,000 contracts daily. And if we put that in context, we actually have more trading on our platform than the sum of all other futures markets put together. So if we look at global futures open interest, or OI, at the likes of OKX, Deribit, Binance, BitMEX, Kraken, I'm sure there's others, that's about $1 billion, $1 billion in total, so not including the perpetuals, whereas our daily OI is about 2 million. So that just goes to show the amount of trading that we have going through the exchange. And the amount of trading obviously means more liquidity, the easier it is to get in and out of positions, and the price at which, the most important thing is the tightness of the bid offer. But maybe I'll pass it over to Nicola or others for the perpetual side.
Look, I think CFDs are, it depends on what kind of risk you're looking for. If you're looking for, risk to exchanges, risk to bilateral counterparties, cleared risk. So, you really have to, clients and counterparts really need to think about the risk profile that they want first. I think it was either Dominic or Jean-Marie that mentioned ISDAs, right? ISDAs have come a long way to really define what that risk profile is this past year. It's something that in traditional finance we're very, very used to, but in crypto, I remember when I started 2 years ago, like there was no concept of like standard definitions on airdrops and forks. And so, seeing ISDA really work towards providing standardized definitions and then, soon to be standardized documentation, I think helps define what the risks are and the rules that you're operating under. But, I think you really have to think through what's the size of my counterparty, what risk am I willing to take to them, and, what even jurisdictional risk, right? I think we've seen that over the past year or so with some of the FTX stuff. And I think why risk is so important before you make a decision on product is that it's not like there's a wide plethora of options out there. So I think really think about risk first. That'll narrow down your options if you're going to trade a perp or a CFD based on what your risk tolerance is, and then you can make the appropriate product decision from there.
Thank you, Nicola.
Well, just to complete Nicola, it's like you had the absence of choice before. Like you have now a complete panoply of different service providers out there offering different solutions, and that's where your risk management framework needs to come in place to dictate what works for who. And typically, the traditional customer of a perpetual contract on BitMEX, for the sake of giving a name, which is a founder of the perpetual contract, so at least we can give them credit for that, won't be the same user as a guy who wants a CFD on B2C2 or NDF. So it's really kind of a client segmentation and a risk framework segmentation more than, how do you transfer one volume to another? And I think as the market mature, the market participant risk framework mature as well, and some of the risks which are ill-perceived right now because people just tend to only look at the surface risk and not at the worst case scenario. And post FTX, nobody would have thought you can go bankrupt for the fraud or an alleged fraud, which make it look like a very different world. So it will be interesting to see how this kind of dynamic change. A couple of years ago, some of these exchanges were not even AML and KYC. So the train is moving, and with the train moving, we're going to see some kind of asset reallocation or product reallocation from one marketplace to another, and concentration change as well.
Thank you for the answers, and thanks for the questions, dear audience. Keep them coming. We will be back to looking at the chat and answering those. Let's go further with my DeFi question to Jean-Marie. Jean-Marie, last year when we had this very same webinar on crypto derivatives, you were saying that at CoinShares you are fans of DeFi, big fans of DeFi, and DeFi continues to develop in an incredible pace. And what's your assessment of the market right now?
Just a bigger perspective, we're not just big fans. Like, there is an elegance in DeFi, which is a bit refreshing when you see that most of the traditional finance infrastructure are dated from 1970, which is an actual birth of Euroclear and not so far away from DTCC in the US. So, if you see that the whole market infrastructure are relying on that, seeing the beauty and elegance of DeFi is almost refreshing. Now, like we see with the ICO process in 2017, DeFi has overextended itself, and we get way too many projects and way too many bad things, way too many products shipped very quickly without security audit, and kind of capitalizing on the fear of missing or of clients trying to, harvest yield everywhere they can. And we had a number of exploits, I would say, starting with running probably a year ago now, until now. As of last night, there was another exploit on Yearn through a Prism bug. So it's kind of like non-stopping, but that's because the market is moving very fast. This being said, there has been some very, very interesting project and very, very almost like landmark institution which has been created in DeFi. If you look at businesses like Aave, like Compound, like Curve Finance, or even like Uniswap, you are facing some of the kind of next generation player, not but you just need to isolate the noise and just focus on what are the quality projects which are coming out of DeFi and how they can evolve. And we are not stopping to be passionate about that. We are in the very, very first innings of the DeFi revolution and what it means. There is plenty of question around KYC, AML. Does that satisfy the regulator if you want to scale it to another level? But as usual, when you get technology-driven financial innovation, it is not done in a way where the regulator see a finished product. This product come in different version, and the V1 is always a bit scrappy, and the V12 is always much more advanced. So it's an evolution process, is very Darwinian to some degree. And as we saw with traditional crypto project, we're going to get a lot of evolution there as well.
Long live permission DeFi. That's what I'm hearing here. Nicola, how are you guys thinking DeFi translating into your products?
Yeah, look, I think we, similar to Jean-Marie, like we love, like, let's be clear. I came from a world where settlement was T+1, T+2, and technology was antiquated. And, we now settle the majority of our settlement requests within 15 minutes. Like that is just like a pure like application of where we need to get to for the entire financial industry. Similar with DeFi, right? Like if you look at DeFi on paper, it makes tons of sense, right? It would take finance to the next level, but it's had a really rough year, to Jean-Marie's point, right? Like if you're looking at getting involved in DeFi and you see the hundreds of millions, probably close to $1 billion now in terms of hacks that have happened over the last year or so, you have to be thinking, well, what is my risk here? And what's the risk that, my funds are also subject to an exploit? And that's got to cause you to pause. And so I think we're really in this like incubation period, not only incubation in terms of like, how do we make the DeFi ecosystem safe and secure, but also I think you're right. It's hard for me to say to our client, well, we have this high KYC and AML standard, but also we trade in this like DeFi space where we don't know who we face, right? So I think permissioned DeFi is definitely something we talk a lot about. We actually don't participate in DeFi currently for that reason, right? And we're looking at different projects, and Jean-Marie is right. There's a ton of information and projects to sift through in the DeFi space. But like, what are the right projects to partner with, to incubate, to make this, a safer environment for all? Because, there's so many applications that can be unlocked if we do DeFi in the right way.
Brilliant. Thanks so much. We have some really good questions in the audience. So let's step on the gas here and then go ahead with my question, and then we take more from the audience. So Payal and Dominic, can you share a few data points, stats on which of your products have been the most successful? We have been hearing that CME options have been going through the roof. So yeah, if you can bring some data to the table and share here, that would be very nice.
Yeah, I mean, it's all about market dynamics, right? So even yesterday with Ethereum's Shanghai upgrade, right, that took place last night, where that was that historic transition to a fully functional proof of stake system that unlocked 30 billion worth of Ether. Correspondingly, we saw huge spikes in Ether futures and options, helping people manage that position and resulting in that real upsurge of volume and OI. So it's real market cases that the futures and options are serving. And the other thing that that was particularly evident over the past month or so is that we're seeing more participants come to our market as the availability to borrow or to go short crypto dried up. So, right now we're probably at historical low volatility. And so after FTX, volatility shot up to about 90%. And right now we're back down at 2-year lows, similar to the back end of 2022. And that number is around 40%. So what that represents is is a huge amount of daily volume. As I mentioned, 10,000 contracts of Bitcoin and Ether, about 40,000 in our micro suite, and that represents, on some days where we see challenges in the broader market space, like following the collapse of FTX or SVB, that shift to CME Group, just in that search of flight to quality. So, our best trading day of the year so far was March 13th, where we saw $4.6 billion in trading. I think JM mentioned the other stat that we really focus on is the number of large open interest holders. And this is a number that the CFTC, our regulator, produces on a weekly basis. And that is any holder that holds more than 25 Bitcoin or Ether contracts. And so, for Bitcoin, that means you're holding about $3.5 million worth. And so that's only a large institution that will hold such a big crypto holding. And so we had a record large open interest holding in BTC futures of 122 such holders. So that really shows you the growth in institutional demand for those contracts. The other thing just very quickly to mention, as we were talking about DeFi, the one thing that our futures settle to an index, and we use the same. So for Bitcoin, it's the Bitcoin reference rate, that index, and we created the same index, or use the same methodology for a number of reference rates. So everything from Solana to Cardano, Polkadot, Stellar. In total, we launched over the past year 25 such reference rates. And that really speaks to the growth that we're seeing in adjacent markets. So whilst we may not have futures and option contracts on anything other than Bitcoin and Ether, we certainly see that development of the ecosystem. So these rates capture DeFi, they capture the metaverse, the layer one, the layer twos, all the things that we're so interested about and our clients are interested about. So trying to bring that price transparency through the use of an index. And as people develop further, we see those indices being used in funds or other OTC activities as well.
Thank you, Payal. Dominic, can you share some stats with us from the house of Signum?
Yes, sure. I mean, we've been offering access to OTC derivatives for our clients since about early 21. And lately we've just launched that portfolio margin setup, which I think is quite a nice enhancement for our clients, makes margin much more efficient, but also on our side introduces a lot of efficiency gains. So we're now shocking portfolio based off of different vol and spot moves and determine margin based off that. So I think that's a nice introduction of the last couple of months. But I think what's more interesting is if we look a bit forward, and I mean the market that we are in is mostly the OTC market, and I think it's a market that is not very transparent to the broader kind of audience overall. I think it's something that happens based off of bilateral agreements, ISTA agreements, and sort of happens below the surface, right? And I think for us, this is quite an interesting market because it offers a lot of benefits as a regulated player. So first of all, you're facing a counterparty that you can actually audit, that you can request for transparency, that you can ask for financial statements and you will get something, which is not a given, by the way, in this market. And you can visit them, you see they're there, and it's a few of these basic things that really matter in this market. And I think the second part is capital efficiency. So trading on credit lines and trading on professional margin setups obviously helps us also to trade more capital efficient, and especially as a regulated bank where, for any on-balance sheet positions, you pay quite high risk weights that obviously punishes any type of behavior that is on your balance sheet. So being able to trade that efficiently on a credit line helps us. And I think this OTC market is quite interesting because we see a lot of developments in that space at the moment. So we're seeing quite a strong momentum across the kind of board to offer an electronic OTC derivatives offering, which there are a number of players that move into that space, and that coincides nicely with our kind of initiatives for this year as well. We definitely see a move, and Nicola mentioned that as well, towards a harmonization of the legal frameworks under the ISTA. And I mean, you guys, Nicola, are on both of these topics at the very forefront of the market. And then thirdly, we're seeing also, margin frameworks getting significantly more efficient and sophisticated, which again helps us also with trading. So I think this OTC market is a very interesting one that maybe there's not that much light being shed on usually. But yeah, we're very pleased with these developments, and we'll definitely also be able to improve our offering on the back of these developments.
Excellent. Thank you so much. Nicola, the next question goes to you. You have been giving access to your clients to bilateral liquidity and cleared liquidity where you work together with CME. Can you elaborate here on what the differences are?
Yeah, sure. So, definitely. So if you think about the cleared space, right, the ways in which we help provide liquidity in the cleared space is number one, making markets in the order book, right? So when you are a liquidity provider, you're often kind of making markets in there, and then people can take liquidity from you in the public order book. The other way is if we have clients that want to move a large block of risk, they typically come to us, they'll ask us to do, a risk transfer trade or a block trade with them. We operate under the CME's rules, and we're able to, instead of them going in and having to think about, well, how do I execute this? How do I put it in the order book? Are people going to figure out that I'm on a big sell program, right? Is there information leakage? They can come to a liquidity provider. We'll work with them to take down the block, and then we'll deal with, kind of the hedging and the risk management on the back of that. And so that can be really helpful when clients get on a large program, times like last night with the Shanghai upgrade. All of those are, you want to be thoughtful about how you're moving your risk. And let's be clear, like the CME is an extremely sophisticated venue. People will know if you do a sell program in ETH, people know that that's happened, right? It's a public order book, and they'll see that. So if you're moving large risk, you want to be really thoughtful about that. On the bilateral front, we do face a lot of our clients bilaterally, which means that we take credit risk to them and they take credit risk to us. I think the main thing here is there's a couple of benefits for them. So flexibility. So if they have custom dates that they want to get access to, doing a bilateral trade allows you to customize that and the exposure that you get. The breadth of product. I think there was a question in the chat around, well, I can only get access to Bitcoin and ETH liquidity. Well, actually, if you come to a liquidity provider, we do offer quite a few, talking my book a little bit, we do offer quite a few, derivative products in altcoins. We offer 31 coins globally, so we don't go as deep as some of the up and coming coins in the market. I'll refrain from using the common term that they're referred to as, but I think that, really breadth of product, right? Because not everything is suitable for an order book. So if you're trading and, your order book's sitting empty all the time, well, that's a product you're probably going to want to trade more bilaterally, because otherwise you're just advertising to the market exactly what you're doing. And then finally, the last thing I would say is that if you want to offer so we provide liquidity to a lot of clients who then offer derivative products to their clients. And so doing that bilaterally gives you the flexibility that then you can then offer it on to your clients as well.
Thank you. And with that, one more question was answered from the audience. So because we have only 5 more minutes, then maybe let's focus on growth further, but like when it comes to geographics, we keep on hearing that crypto derivatives are really popular in Asia. Is significant growth there, Payal, what you have been seeing, and also Jean-Marie, if you want to elaborate on geographical growth when it comes to crypto derivatives, what you have been seeing with CoinShares.
to comment on the geography. So I'll leave it to Payal.
So yeah, for our USD Bitcoin Ether contract, we see global participation. So obviously we are a CFTC regulated firm and the majority of our trading is out of the US. But actually 40% of that flow comes outside of from outside of the US, and trades are submitted it from about 120 different countries worldwide. And what's really interesting is 40%, as I mentioned, of that flow comes from outside of the US. And that means that half of the flow actually happens before the US is even open. So Europe and Asia really representing a large share of that. And as part of that, we launched a Bitcoin Euro and an Ether Euro contract just to tap into some of that flow that was coming out of Europe as well. And this is something a little bit different that we see than in traditional equity markets, where that share of how much is coming from US markets versus outside of US or outside of US hours, the percentage share is nowhere as equal as we see in crypto markets. So it just goes to show how global this market really is.
Thank you very much. Dom, do you have anything to add here? You guys have opened an office recently in Abu Dhabi, and that means that there is a lot of demand in the Middle East, as we have been hearing. If you have anything to add to this one, after that we can go to my last question.
Sure. Yeah, I'll keep it short. I mean, Singapore and Switzerland are and will remain our main hubs, but I think in certain jurisdictions we definitely see potential, such as, for example, Abu Dhabi, Luxembourg as well, and hence have also increased our presence there. I think what makes Asia and the broader Asian region interesting alongside Switzerland is definitely that kind of focus on structured products that both of these hubs already bring with them into traditional or with traditional underlyings, right? And I think that's sort of the next level that crypto derivatives can unlock. Of course, we need a lot of education still. Of course, there is a lot of getting warm with the idea to be done yet still, because I think many investors, if they see today you have a 40% APY, they get confused rather than interested. So I think there we still have a lot of work to do, and I think that is one of the reasons we're also expanding our global presence, because we think there's a lot of potential in the market that is already used to and familiar with the concept of structured products, and we can definitely expand into that direction there. Yeah.
14%. I can recall a time when 30% wasn't even that mind-boggling. Thank you so much. So my last question, which goes to all of you, what is that development, or what development are you the most excited about? If you can keep it brief, I'm thankful for that. Nicola, you want to go first?
Sure, I'm happy to. Mine's maybe going to be a boring one. I'm going to say, like, just standard is the documentation. We spend so much time, especially in derivatives, onboarding clients and going back and forth on legals. I think it would, the derivatives market would grow so much quicker if we could get clients, into the space in a way where they understand the risks of it. And also there's like a standard, documentation that everyone kind of agrees to. And so instead of, possibly taking weeks or months to go through bespoke ISDA documentation, you have standardized documentation that everyone's just happy to sign with, kind of right off the bat.
Fabulous. Thank you very much. Jean-Marie?
Sorry, mine is completely tangent. It's much more to do with Europe place in the world chessboard, and how the US is a bit of a mess right now in terms of regulation. Europe has been pushing quite strongly on MiCA. The Swiss FINMA and the Swiss Federal Law has been pushing quite well. So the Europe at large, I would say, has been doing quite well on that front. So there was a declaration from President Macron last weekend about the EU sovereignty and how it was important for EU to become and stay independent, and how this would translate in crypto, and in a world which is less globalized and more regionalized, what would be the impact on crypto? So that's what I'm looking at.
Thank you very much. Payal?
Three very quick things, I think, for me. One is the boring one, if I may say, so regulation, and making sure that that regulation is fair, but equally it doesn't swing so far that it stifles innovation. But I think that regulation will give clarity in terms of development and bringing new products to market. Number two, I think technology, and the things that we saw with Ethereum, the merge, the Shanghai upgrade, Bitcoin halving next year, and all of the things that will spark such market events and a need for the products that we've all discussed. And I think thirdly, it's economic events, right? So the Fed tightening, risk appetites, and the use of derivatives, whether that's futures and options, CFDs, funds, ETFs, all of those, and how they work together to help people risk manage and put their capital to the best use. So I think it's a mixture of those three things that I'm most excited about.
Thank you so much. Dominic, last but not least.
Yes, also boring, but maybe a different kind of boring. I'm most excited about automation. Anything that goes electronic, that we can automate, that we don't need someone to sit in front of a machine to perform, is exciting for me, and I think is the direction we want to go into. So that's definitely our main focus. And then if I think, in the broader, from the perspective of the broader market, in my view, derivatives adoption is kind of a function of two factors. It's the spot market adoption and investor sophistication, right? And I'm confident that we will continue to see like a positive development on both of these fronts. I mean, we're definitely noticing it. So I'm sure the future is very bright for crypto derivatives.
I love the automation answer, such a Web3 response. Thank you so much to each of you. We have some really good questions in the audience, but I want to be mindful of your time. So I encourage the people who ask the questions to reach out to the panelists. And a grand merci one more time, Payal, Nicola, Jean-Marie, and Dominic. I put my hands together for you on behalf of the CVA. Thank you so much for this terrific webinar. Looking forward to the autumn edition, Crypto Derivatives 2023. Bye for now. And I wish you all a good rest of the week.
Thank you, Emi. Thanks, everyone.
Thanks.